Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, and I'd like to wish everyone a very happy new year. Today, I'd like to highlight our fourth quarter market review and outlook report. In our third quarter Huddle newsletter investment report entitled Tricks or Treats, What Comes Next, we stated that in the fourth quarter, stocks will likely outperform bonds as economic conditions are generally positive, employment data remains solid, core inflation continues to subside, the Federal Reserve stops raising interest rates, and the stock market anticipates an earnings recovery in 2024. We also indicated that bond yields had become very attractive. Indeed, in the fourth quarter, the S&P 500 rose 11.7%, foreign stocks rose 9.8%, and bonds were up 6.8% as interest rates peaked in October. In our newsletter, we noted that despite a number of negatives for the market, such as tensions in the Middle East, rising mortgage rates, pandemic stimulus, money running out, sluggish bank lending, and rising gasoline prices, many positive factors were in place to bolster the stock and bond markets. We highlighted that inflation would likely continue to abate, that unemployment remained low, and our belief that the rate hiking cycle by the Federal Reserve was near an end. In addition, we pointed out that third quarter GDP and 2024 corporate earnings estimates remained strong, and that the U.S. consumer continued to spend as wage growth was starting to exceed inflation. Finally, we indicated that stock market valuations were not excessive if one excluded the 10 largest companies in the index. Fast forward to today, and many of those same positives remain in place. Inflation, the key factor in the decision-making process, the Fed has declined to a level that no longer calls for additional Fed tightening. The favorite inflation index used by the Federal Reserve is the Core Personal Consumption Expenditure, or PCE index, that removes the volatile impacts of food and energy prices. While the most recent data show a 3.2% year-over-year increase in inflation, the recent trend of monthly data shows a reading of only slightly above 2%. This is important because the Federal Reserve has declared that 2% inflation is their long-term goal. Based on commentary at their last meeting, we believe the Fed has likely finished the rate hiking cycle that began in March of 2022 and led to 11 increases totaling 5%. The jobs picture continues to be a positive for the markets as unemployment remains at only 3.7%, and unemployment claims remain at modest levels. As long as employment remains strong, we can reasonably assume that consumer spending, which makes up 2/3 of our economy, will be supportive of sustainable economic growth. However, after a period of strong consumer spending on services due to excess savings from pandemic relief funds, a slowdown in 2024 would not be a surprise. Credit card delinquency rates, while not yet at levels that warrant real concern, are worth watching to assess the overall health of the consumer. The Conference Board, the global nonprofit think tank, forecasts that real GDP grew by 2.4% in 2023, but expects it to slow to 0.9% in 2024. However, following this downturn, the U.S. economy should begin to normalize. They forecast 2025 GDP growth to come in near potential at 1.7%. In an environment where inflation is decelerating, interest rates have peaked, and the economy is growing at a modest pace, global corporate earnings can rebound this year from 2023's tepid levels. Spurred on by earnings growth from large U.S. companies, technology, industrials, communication services, consumer discretionary, and healthcare sectors are expected to generate double-digit earnings growth in 2024. While the stock market may spend some time in the first quarter digesting the impressive gains experienced in the fourth quarter of 2023, as long as we continue to get positive news regarding our three pillars of the investment landscape, inflation, interest rates, and corporate earnings, we believe that both the stock and bond markets can deliver modest growth in the first quarter of the year. Though the current valuation of the S&P 500 is above its historic average, excluding the 10 largest stocks in the index, valuations remain much more modest. In addition, as we have previously pointed out, the massive $6 billion currently held in money market fund accounts can be a source of fuel for both the stock and bond markets as the Federal Reserve likely cuts interest rates later this year. Thank you for watching today, and please read our full market review and outlook report for greater detail on the fourth quarter and our forecast for 2024. Take care, and we'll see you next time.